Welcome to the fourth quarter market review and investment forecast. This is Stacy Francis, joined here today by Avni Ramani to talk to you a little bit about what has been going on over the last quarter of 2018, and more importantly, what to expect for 2019. I know this has been a tough year so far. In fact, we saw last year was one of the most volatile years that we had seen in nearly a decade. And guess what? Well, 2019 is serving up a lot of the same. So it's more important today than ever before to understand what's going on with your portfolio, understand what's going on with the market, and most importantly, have the knowledge to be able to continue to make smart decisions about your portfolio. So thank you for coming today, for investing in yourself, and we're going to be going through everything you need to know to make great decisions moving forward. So market review. Well, it was quite a quarter. Global headlines finally started to impact the U.S. stock market. That is, concerns about a trade war potentially with China, concerns about Brexit, and news with that is truly up to the moment and changing on a minute by minute day. And interest rates, as we know, interest rates have been definitely in the news, and they continue to be in the news. But ultimately, what has happened is that after a year of hearing essentially every possible negative scenario that could occur, we see that it's starting to impact the market, and the stock market is starting to essentially be more volatile than we've seen it in the last decade. Well, how did that impact it? You can see it by this chart. And really, you don't have to look at the nitty-gritty of this chart, but what it shows you is that for 2018, there was really nowhere to hide. There was nowhere to hide in stocks in 2018. Only bonds. You can see U.S. Treasury bonds did well, okay, all right, not too bad. And the aggregate bond index was essentially flat for the year. But every other asset class out there had a pretty tough year. The S&P 500 down nearly 5% for the year. The Russell 3000 even faring worse. The areas that felt the worst out of all of that, you can see emerging markets were down a little over 14%, and you can see also international down as well. So really nowhere to hide in all of 2018. But 2019, we'll be talking about that. We're starting to see some upside. But more importantly, 2019 is a really key year for everyone to look at their portfolio and to make sure that you're allocated with the ideal asset allocation. Because the losses we saw last year are indicative of a time when things are going up and they're going down. And with more of the same, you need to make sure you have the right allocation. Because if you don't have the right allocation, eventually the losses, the ups and downs that you are going to see will erode your self-confidence, your will. I liken it to this. If I'm on a diet, I do not have Godiva chocolates on my desk. Why is that? Because, maybe the beginning of the day, I will be good. I will look at them. I will not eat them. But typically around 2:30, 3 o'clock in the afternoon, when I start to get a little tired, maybe need a little pick-me-up, what do? I reach for those Godiva chocolates. Well, it's the same thing with your portfolio. If you don't have the right allocation and you're seeing too much volatility in your portfolio going up and down, well, for a while, you might have the willpower to handle it. But eventually, maybe a bad day, maybe just because you're tired, you can't handle it anymore. And studies show that individuals who make changes to their portfolio because of what's going on in the market tend to make mistakes. Essentially, they sell when their stocks are not doing so well. They buy when stocks are doing great, which historically have been the worst times. So making sure you have that right portfolio allocation is a key goal for you for 2019 and beyond. As we talked about stocks, they were down. We're now just looking at the fourth quarter. So overall, a negative year for 2018, but the worst were that October, November, December timeframe that we saw at the end of the year in 2018. U.S. stocks were down 14.3%. International developed stocks down as well, 12.78%. And even emerging market stocks, well, they were down too, 7.47%. The only area that really saved the day were your beautiful bonds in your portfolio. So our bonds in our portfolios are very high quality. They actually did very well in the fourth quarter, essentially bolstering and holding up the returns of the portfolio overall. But again, something that's really important for you to know is to make sure that if you don't work with a financial advisor, that you are putting enough bonds in your portfolio to make sure that you can weather the ups and downs that you're going to see on a daily basis in 2019. Let's take a look at the long term. Well, one year we talked a little bit about how every single asset class was down except the U.S. bond market. But this is important for you to see. Do you see the 5-year? All of those asset classes were up. So what this story is telling you is not just to focus on the short term. We all are long-term investors, and I can confidently say that because even someone who might be an investor in their 70s or early 80s, we're still looking at a time horizon of that portfolio at least till age 95. So often you're looking at that for another, well, even 15 years out. And the 10-year, well, the 10-year has even more positive news. As a long-term investor, that 10-year, your return on U.S. stocks has been on average 13% each year over the last 10 years. International developed 6% each year over the last 10 years. 8% a year for emerging markets, and U.S. bonds doing fairly well as well. So this is such, I think, a beautiful chart to show you again the chaos of what we're seeing in the short term. Don't let that forget. Don't let that make you forget that the long term, that equity, that stock exposure, that diversification between U.S. stocks, international developed stocks, and emerging market stocks is key, is absolutely key to be the engine to move your portfolio forward. So now we're going to jump into U.S. stocks, and my wonderful colleague, Avni Ramani, is going to take over and take you through a lot of what we were doing, thinking, and what you need to know for 2019 and beyond.
Well, hello, everyone. Thank you for joining us. I'm going to talk a little bit about what the U.S. stock market did and how we're thinking about that. I love this cartoon. This is a roller coaster ride. It reminds me of a roller coaster ride I took with my daughter about 3-4 years ago. And we went on this crazy roller coaster, up and down, up and down. And the first time we went on it, we got the frights of our life. But then there were no lines, so we said, oh, let's do it again. And so we did it again. And the second time around, it didn't quite seem that thrilling. And when we got off that second time, my daughter begged me to do it a third time. I'll tell you, the third time I was so relaxed, I could have been getting my nails done. But our memory, our short-term memory, unfortunately, when we deal with the stock market, isn't this fresh. And we forget the past few times that we take this roller coaster ride. So every time this market volatility hits, we think this is the first time we've been on the roller coaster. But you see that stock market expert over there? That's a part of the role that we financial advisors play. we encourage you to stay in the market, to stay invested, and go again. And let me show you why. Um, as you see in this chart, in 2018, the volatility came back with a bang. What this chart is showing you is the price movements, either plus 2% or minus 2% on a daily basis for each of these calendar years since 1999. If you see the far right end of the chart in 2018, we saw 20 such days of either plus 2% change or minus 2% change. But if you see the years prior, 2017, there were 0 such days. 2016, there were 9. 2015 was an average since 1950 of about 10. And before that were low 2. So the last time that we've seen this type of volatility was in 2011. And we've seen it come back, and now we're going on this roller coaster ride again. But hang in there, because we know that this happens, and we just have to go through it. What Q4 showed us in 2018 was that the US stocks are no longer the go-to asset class. They had been the go-to asset class for many years, but now they're proving that they are not invincible. They're no longer invincible. They were impacted by a few different things, but the biggest one was the rising interest rates. The Federal Reserve increased interest rates in 2018 to many people seemingly pretty rapidly, and this had a huge impact on the stock market. But what economists know is that an increase in interest rate actually signals a pretty strong economy. And that is why they don't want the economy to get too inflated and too bubbly. And that's why they start increasing the interest rates. But it's because the economy is really strong. And a strong economy signals strong companies, signals strong earnings, and therefore should signal a strong stock market. So that is why we need to keep that in the back of our minds when we think about these things. The economy has been extending. As we know, this has been the longest bull run in the history of the market. Well, we're getting close, actually. This is the second longest expansion on record. And if this continues through July 2019, then it would become the longest expansion in the history of the markets. So as we can see, that this strong economy is really carrying the markets through. Even the corporate earnings are really strong. They've been increasing over the past 4 or 5 years now, and they continue to do so. Q4 saw some challenges, but what that shows is that it's a good thing. You don't want the economy to grow very strongly, because that then signals that there could be a bubble somewhere. But when there are some challenges, a couple of quarters of challenges in the economy, that's a good thing, because then the economy is not too hot. And it's a perfect combination of not too hot, not too cold. It's just right. So do we think this US stocks are a good deal? We think these stocks are a really good deal right now. Even if you look historically, we've seen that late in the economic cycle, the returns can be very, very good. And as we see here, in the returns tend to be pretty strong 13 to 24 months into the cycle, as compared to fewer months, like 1 to 24 months. The 7 to 12 months is very strong as well. And the more recent cycle, investors have reaped the benefits in the 7 to 12 months prior to the recession in the cycles. And then because of this Q4 slowdown, US large cap valuations are now actually looking even better. This is the time to buy. They are on sale. So US large caps are a really good deal, and they have been undervalued. This is the first time that they've been undervalued in the past 10 quarters. So really, this is a really good time to get into US large cap markets right now. US small cap markets, they are also undervalued. Small cap companies are those companies that have a valuation of less than 2 billion. So it's not no-name companies. You've probably heard of some of these companies like Shake Shack, 1-800-Flowers, Sonic. So these are not no-name companies, but these are smaller valuations compared to the large companies that are more in the $10 billion valuations. So these companies are an even better deal. Their price to earning ratios have fallen to a point where compared to the past 10 quarters, this is the best time to buy them. So what all this is showing us is that this is a sale. The stock market is on a sale right now. Now you would say, okay, but what about looking ahead? Are they poised for a rebound? You know, you never know. As Stacy mentioned before, you never know when the market's going to go up or down. But what we have seen is that returns following down markets have been very, very strong. So if you look just in the recent past, September of 2008. So 2008 was the recession, the big crash. But look at this bar 5 years out after that stock market crash. Markets have returned 47%. It's phenomenal. Look at the one before that. This was the September 2000 timeframe after the terrorist attacks. After 1 year, the market was down -1%. There's no question about that. But look at the 3-year return. 3-year return is 40%, and the 5-year return is 81%. So, and you can see this at every point in the past after a crash that the markets have rebounded tremendously. So we're looking at these markets continuing to grow and these markets being high. As we look through this now, we say, okay, so how does this really work? When we are looking at the stock markets, you know, there are some people who are afraid of them, and you know that's fair. It's because it's a hard thing to do. You are looking, if you are looking at buying at the right time and selling at the right time, no one in the history, and there are so many research projects done, no one has gotten it right consistently every single time over a long period of time. So the whole idea of buying and selling at the right time is misguided. And what we encourage you to do is to stay invested throughout these ups and downs of the market so that you're not tempted to sell out when the market crashes, and neither are you buying at a point where the market is at a super high because look at how much money everyone else is making. So that's the key about these markets, is to stay invested throughout these cycles. Here's a beautiful chart that shows you why you should be staying invested. If an investor had put in $10,000 on January 1st, 1997, these are the results that they would have got through the end of December 30th, 2016. If they were fully invested in the market, and remember, from 1997, so we're talking about the 2001 crash, we're talking about the 2008 crash, and then we're living through this historic upswing in the market. If you had stayed invested throughout, you would have had a return of 7.68% year on year every year. You would have been at 43,933 right now. Now, let's see if you missed the 10 best days during this time. Only the 10 best days during this 20-year, 30-year time frame. Your return would have only been 4%. Had you missed the 20 best days, it would have been 1.57%. Now, this is the reason why you want to stay invested in the best days as well as the worst days, because you can't really tell beforehand whether it's going to be the best day or the worst day. So you stay invested. So that was about the stocks. Now let's look at the bonds. You know, of course, we all have heard about the increasing interest rates, and already we've seen quite a few under Powell. So we are likely to see the rates increase, not very frequently, but it is on the cards. It is on the cards right now for increase. So how does the interest rate increase impact bonds? Let's first talk about the longer term bonds. The longer the maturity of a bond, the more it gets affected by a change in interest rate. So if the interest rate goes up, bond prices fall, and this impacts longer term bonds more than shorter term bonds. Now you might ask, why is that? The reason is that in a long-term bond, if the long-term bond is paying, let's say, 0.25% in interest. Now, if you have a 20 interest payments coming to you over the next 20 quarters, let's say, and you're getting 0.25% of these interest payments, you are looking at just, continuing that for the next 20 payments. But if you have a shorter term bond and you're getting 0.25% and you only have 2 interest payments left, now if the interest rate increases, you only have 2 more payments left on the short term bond. So when the bond matures, you can always buy another bond that pays you more because interest rates have just increased. But if you're stuck with the long term bond, you have to wait for 20 more quarters in order to be able to get out. Therefore, the price of this longer term bond will fall. People will value the longer term bonds less than the shorter term bonds in an increasing interest rate environment. Just very quickly, what do we consider short-term bonds? They have a maturity of between 1 and 5 years, and their sensitivity to interest rates is pretty low. Intermediate-term bonds have a maturity of between 5 to about 12 years or so, and their sensitivity to interest rates is about medium. And the longer-term bonds, as we mentioned before, have a higher sensitivity to interest rates, and they're between 12 to 30 years in maturity. In our typical portfolio, we tend to focus, especially in this increasing interest rate environment, on shorter term bonds and a little bit in the intermediate term bonds. But even in that intermediate term space, we are on the shorter end of the maturity cycle. And we have currently no long-term bonds in majority of our portfolios. We are actually very excited about floating rate bonds. Now, floating rate bonds, is maybe you've sort of guessed by the name of it, is a bond that has its interest rate pegged to an index. So this index could be the federal funds rate, the prime rate, treasury bill rate. Different bonds pick different indexes, but they're pegged to a certain index. And when that interest rates on the index rises, the floating rate bond interest rates rise. And when the interest rate falls, it falls as well. So especially in an environment like this, where interest rates are increasing, these bonds are great because they provide that security as well as the potential for income when the interest rates are rising. Now, let's move on to international stocks. This part of the market gave us some heart palpitations in Q4 because just all over the world, it was a pretty, disappointing fourth quarter, and 2018 because of the fourth quarter. So the international stocks, again, all over the world, they were doing pretty poorly. Emerging markets also had quite a rough Q4. As you can see, a lot of these countries had a negative return. Now, that's unfortunately the nature of this market, both developed international and emerging markets. As you can see in Q4, both were over negative 14%. Now, this is a classic of trying to keep the focus on the long term. And Stacy showed the chart of what the Q4 did with the past 5 years and the past 10 years returns for all these asset classes. And I remember that the emerging and international pieces were pretty strong in those charts. So again, it is important, especially when you're dealing with international markets, to have your eye on the long term. Now, again, you might ask, why is that? The reason why we're especially excited about emerging markets is because they are continuing to expand. Emerging markets represent the faster growing area of the world. So we're especially very excited about this long-term prospect of the emerging markets. And one of the studies that McKinsey did recently shows that almost 2/3 of the world's GDP growth and more than half of new consumption over the past 15 years has come from emerging markets. This is very exciting. Now, I grew up in India and I still have my family there, so I try to visit every year. And it blows my mind every time I go there because of the growth that the economy is experiencing. Now, granted that India is one part of the emerging markets, but this story is happening all over emerging markets. We are seeing a middle class rising in those countries. More of these people have more power to consume. And what does that mean? It means more demand for goods, more goods for companies to produce, and more these companies are then creating profits and putting them back in their companies. So it's a growth economy over there. Now, this McKinsey did a study about these economies, and they said that the emerging economies will, in the next 15 years, represent 62% of total global consumption. This is a mind-boggling number. 62% of global consumption is going to be, and these are all going to convert into profits. So we are extremely excited about the growth prospects of these economies. Even the international earnings, they're strong. These markets, by definition, are volatile because some countries may have a political situation that's not stable, or some countries may have a geopolitical conflict going on, but just their inherent economies are in a position where they are growing really, really strongly. So are international stocks a good deal? We think they are a great deal. Because of the beating that they received in Q4, their price to earning ratio, which means the price at which the stock is selling versus the earnings that these companies are capable of, is reducing. Once the price lowers, this PE ratio comes down. And that's when it becomes more attractive because the earnings potential signal that the price should be much higher than what we're seeing right now. What does that mean? It essentially means this market is on sale. So we are very excited about where they're at right now and what their growth prospect is going to be. And they're looking so much better than they did even compared to early last year. So again, what do we think? It's time to buy. And I'm going to pass you back on to Stacy, who will continue with the presentation.
So this is my favorite part, the importance of diversification. And what I always bring it back to is, I don't know if any of you grew up with the Easter Bunny visiting you. Well, I did. It was actually one of my favorite things, favorite holidays. And the thing I never understood is how the Easter Bunny could manage to get so many different types of candy in my Easter basket, which was perfect because I had some chocolates, I had some gummy bears, and the better the diversification, the more the different types of candies, the more excited I got. Well, it's the same exact thought process about what makes a portfolio really good. And so avoiding this trap, just like the Easter Bunny, you don't necessarily want to have all chocolate. You want to have all different types of candies. Well, it's the same thing with your portfolio. You don't want to necessarily have all U.S. stock, because all U.S. stock means that you're not getting exposure to the rest of the world. And I understand that being here in the U.S., we can be very U.S. focused. I mean, it's, in fact, even our news stations are much more predominantly focused on the U.S. than outside the world. But this home bias, unfortunately, really hurts us long term, because international non-U.S. stock exposure is really diverse, really important. It's very valuable for diversification, and also it's important for future returns. The reason why important for future returns is that over the last several years, international has actually underperformed versus U.S. stock. Now, because of that, it makes it more attractive going forward, because you see that right now, U.S. stock, even despite the pullback, U.S. stock is still relatively expensive, at least compared to the low prices that are available to purchase international stocks. So it's really important that even though the U.S. has outperformed recently, we know that the tide of outperformance of U.S. stocks is coming to an end. And the time the empire of international stocks outperforming is right around the corner. So did you know that from 2008 to now was a lost decade? It was a lost decade if you only had invested in U.S. stocks. So you can see the lost decade from 2000, January 2000 through December 2009. Had you only invested in the S&P 500, that decade would have been a lost decade for you. You would have had a negative almost 10% return. The U.S. and only investor would have missed out on huge gains that we saw in other parts of the world. So the MSCI world, essentially international developed as well as emerging markets, excluding the U.S., so not having exposure in the U.S., look at that, almost a 20% return. The World Small Company Index, so not including the S, just not including the S, only small company stocks, almost 100% return. Look at this, Emerging Market Index, 154% return. So this was a wonderful decade where we saw from 2000 through 2009 where actually international stocks outperformed. But it was only recently in this last decade that we've seen emerging markets and developed international underperform. So this next chart that I want to show you, I love it because number one, it's, well, absolutely confusing from the perspective of trying to figure out if there's any patterns. But let me tell you what this is. So this looks at 2008 through 2017. And at the top, the very top that we see here, all of those top performers of the year. In fact, 2008, not to be surprised, such a bad year for stocks, bonds were the best performer. 2009, emerging markets. Then 2010, real estate investment trusts, Treasury inflation protected securities in 2011, back to emerging markets. Then, wow, we throw small company stocks in there. So this is a really interesting chart because you can see both the best performers of each year and then here at the bottom, the worst performers. So going back to emerging markets, a lot of individuals are very wary despite the great news of everything that Avni shared about how much promise this area of the world has. You can see emerging market stocks were the worst performers in 2008, but the best in 2009. Fared decently in 2010, worst again 2011, but came back up in 2012. I don't know about you, but like this right here is like as volatile as you get, right? Look at this. But what's really powerful and what's really important to know is that emerging markets, yes, can be the worst performers, but also can be the best performers. And remember back to that chart that we just looked at 2 seconds ago. From that time period of 2000 through 2009, what was the best performer? Hands down, this asset class right here, emerging markets. So what's important about emerging markets is to make sure that it's part of your portfolio in good times and in bad times. And the reason is that as you can see from this chart, there's no real pattern of when emerging markets is going to have a year of absolute outperformance above all allocations, all other stocks, and when there might be a year where we see emerging markets not fare nearly as well. So making sure that international is part of your portfolio is really key. So I'm going to prep you. If you thought this was a lot to look at, sit down, because this next page is even more. So this one goes back all the way to 1998. So we added a whole nother decade on. It's the same type of thing that we're telling you, but what we did here is we wanted to show you the pattern of U.S. stocks. So we just looked at emerging markets. Here we look at U.S. stocks. And going back from 98 all the way through where we are, 2017, this goes out that far. Again, there's no real pattern between when we see the top performer for U.S. stocks and when we see the most negative performance. Here in 2014, it was the best performer, but you can see very clearly just a few years before, it was one of the worst performers in 2009. So again, making sure that you have a diversified portfolio is important because there's really no pattern to U.S. stock performance versus international. And actually, we just took a couple countries here. Actually, I'm a little biased to Ireland. I just booked a trip. I'm so excited. We're taking my English family, my husband's family, and there's like 15 of us. And we're going to go to Killarney, and then we're going to go to Dublin, all of us together. My mother-in-law had her wedding honeymoon 50 years ago in Ireland. And so we wanted to take her back there and have this experience. Well, interestingly enough, how did Ireland do over the, over this last decade? Did pretty well, actually outperformed the United States. Australia did fairly well. The United Kingdom did fairly well too, as well as Singapore. So again, looking outside the United States, you would have missed all of this wonderful performance from other countries. So is it a boom? Is it a bust? Well, having exposure outside of the US, that diversified approach leads to the happy face. And I don't know about you, my daughter is completely into emojis. Right now we're planning her Valentine's Day party. I actually checked with my husband before I did this because I knew I would be putting my marriage potentially in danger. She really wanted to have some friends over for a emoji Valentine's Day party on Valentine's Day, which I, to be honest, didn't know that emoji Valentine Day party actually existed. But I went on Oriental Trading, and funny enough, Oriental Trading has all the party gifts you could imagine, from emoji balloons to emoji tablecloths, napkins. It's all there, all in Valentine's Day theme. Well, what essentially these emojis, while they seem kind of funny, they really give you a strong message. And what this strong message is that US stock plus international equals a really happy emoji. And at least I know with my daughter, it equals a very happy 9-year-old. So let's focus on what you can control, because I have to say, I think what's challenging, and I was on Power Lunch last week talking about this, and Avni was on Bloomberg Radio also very recently. We were talking about the market, and in particular, the concerns that individuals have about this market. The feeling that they have no control over what's going on. Well, there is, though, a lot what you can control. So, number one, letting the markets work for you. Number two, being efficient with taxes in the way you invested. The way that you invest also being the lowest cost possible. And then also diversifying and staying disciplined. So this is a lot. Let's dive into one of those. So the best investment philosophy that really encompasses all of these best practices that we just really quickly went through is using emotion-free, proven investment formulas. Essentially eliminating the emotions from your investment process. It means that the decisions you make are going to be sound. They're not going to be based on any type of gut reaction to what might be happening in the current circumstances. It's more long-term and, most importantly, based on academic research and good investment decision making. Because we know that your investment portfolio, yes, it's money that's working for you, but it has a bigger role than just that. It really is the foundation for your whole life. I mean, I think about it. I was talking to my kids this morning over breakfast, and very proud, because I said, guess what? Mommy and Daddy are going to put some more money into your 529 plan for college. And that's going to allow you to be able to afford to go to any school you want. Now, I'll be honest, we're not 100% there. With this additional money, we'll be halfway there. So we have more work to do. When I look at that 529 plan, yes, I look at how it's invested, and that's very important. But really what those dollars represent is it represents my wish, my dream for my children to be able to go to the college of their dreams and not have to worry about any type of student loans. Now, don't worry, I'm going to make them get a job there, right? And they have to pay all their, all of their living expenses, because I want them to, at least have a stake in the ground. But the reason why I bring this up is that your portfolio, it's not just about making money. This portfolio allows you to achieve your goals, whether that's a gift for your children, as I'm talking about, or a gift to you and your spouse or the people you love, of being able to actually hang up your hat and be able to retire one day. So remember that because this, again, is for long-term growth, remember that when it gets scary, remember what your goals are. And remember that the longer you stay invested, the smaller the chance you have of losing money in the markets. Again, let me say that again. The longer you stay invested, less of a chance you have of staying in the markets. So are you okay? Are we okay? That's a big question. And so if you are not working with a financial advisor and would like a second opinion, I wanted to tell you a little bit about our service. We offer a second opinion service because 80% of individuals who were interviewed by the Wall Street Journal said that they would appreciate a second opinion. Essentially, it's an X-ray analysis of your entire investment portfolio, ensuring that you're on track to reach your goals. And one of three things could happen. It could be that you are perfectly invested, your financial advisor has you in the right allocation, and things are great, and there is no change that needs to be made. It could be that you are perfectly invested, maybe a tweak here and there, but for some reason, you don't feel like your financial advisor is the right fit. Or it could be, and we've had this happen a few times, that either you're working on your own or you're working with an advisor, but somehow that portfolio that you have is really not the right fit, almost like you're trying to wear your big brother's clothes and pass them off as their own. We often see this where someone who hasn't really actively managed their portfolio recently or rebalanced it, if they've gone through a divorce, if they've inherited a portfolio from a relative due to a death, or maybe even, unfortunately, their spouse passing away. But if you are concerned, I would say please do reach out, because we want to ensure that you're on track. You're on track to reach your financial goals, because there's a lot going on this year, and there's going to be a lot of volatility. So please reach out to us. We've got a great team. We just received, actually, I'll show you the award I'm most proud of, and Avni's very proud too. We got the 2008 Top Wealth Advisor Moms from Working Mother magazine. That's our most recent award. You can see that we have all these other amazing awards too, but that one is really nice too, because as many of you know, balancing a career and being a working mom, not always easy, but again, the most worthwhile, wonderful thing. And this is our team, good-looking team, I have to say. In fact, I had someone ask me once, they said, in your screening for candidates, do they have to be good-looking? I giggled because, yeah, that's not it, but we have both smart inside and great people inside and out, a team here that I have to say I've never been so proud to be part of, great people who really care about our clients, and I have never felt so confident and excited. So please do call and email us with your questions. It's info@francisfinancial.com. You can reach out to us 212-374-9008, or you can visit our website at www.francisfinancial.com. From myself, Avni, and the entire Francis Financial team, I want to say thank you for investing in yourself, educating yourself, because an investment in your financial education is the best investment you can ever make. Thank you.